Hey, welcome to the Everyday Investor, podcast where diverse thoughts mingle with open minds to produce better results tomorrow with what we have in our hands today. Today, we're going to delve into the realm of passive investing. We're honored to be joined by Tim Edwards, the Managing Director of Index Investment Strategy at S&P Dow Jones Indices, or S&P DJI, with a distinguished past at Barclays Capital and the Royal Institution of Great Britain, as well as having a Ph.D. in pure mathematics. Tim's expertise spans a wide range of investment strategies and market insights that will help us, hopefully, better understand what passive investing is and why we should be considering doing it. Because, of course, this isn't financial advice. Now, as an investor myself, though, I use passive funds myself within my own portfolio. But I also use active funds too. The reason why? Well, I seldom could claim neutrality here or lack of bias. I see the case for both, especially at the moment. I try to sit on the fence on this topic professionally. A pre-existing bias of any sort is a conflict of interest that I need to make apparent. So it's important to recognize, though, that being a passive investor doesn't imply laziness. And you're not a passive-aggressive investor either. You're just using passive instruments. It's just about adopting a strategic and systematic approach with your investing. The focus isn't on outperforming the average by getting your timing right and diligent research, but it's about data. It's about consistency and harnessing the mysterious force of compounding returns at the lowest cost possible. Like a silent sentinel, passive investing tracks and emulates the ebb and flow of market indices or sectors instead of making promises of outperformance from stock picking that can't be guaranteed. Passive investing typically involves dollar cost averaging, or just investing the same amount continuously over time, no matter what the price is, into instruments such as index funds and exchange traded funds. This approach allows investors to gain extensive exposure to investments simultaneously across a predetermined jurisdiction, industry, or theme, all with a lower requirement for trading or active decision making. If you are enrolled in the New Wealth Foundation's course, we have a whole lesson devoted to the question of active or passive. We go right down the middle with this one as well, so I think it's important. Check it out if you haven't already. A link to sign up to New Wealth Foundations is in the show notes. But whether passive or active is your gig, never forget that to invest is to have an active strategy already, regardless of whether your chosen tools are actively or passively managed funds. You're the one in charge. You're the one that gets the results, both good and bad. That's as active as you can get. So, what are the criticism of passive investing then? Well, some investors really don't like being told there's no point aiming for above average because statistically you can't succeed. It may be true, but it can also be a little bit patronizing, especially for those who either understand the markets quite well or maybe they have a particular knowledge in a niche that they've chosen. I then consider value investors as well, especially those who buy and hold shares in individual companies directly. They use a process, but they actively make decisions around when it is the best time to buy and when it is the best time to sell based on the research and the formulas they use. There are really great people in this space achieving awesome results. From what I've seen, there's more than a few examples of investors consistently beating their benchmarks. Lastly, some would also suggest that considering we're on the precipice of an AI-infused digital promised land, surely there's opportunity for outperformance in this new frontier, right? So let me now define what active investing is first and then offer some criticism there for balance. Active investing involves strategically selecting and managing individual investments with the goal of outperforming the average performance of a bunch of investments measured collectively. When it comes to active investing, especially at the fund manager level, the evidence suggests consistent performance can be somewhat lacking, or consistent outperformance can be somewhat lacking. And as you'll learn today, even in a volatile market where you'd expect someone at the wheel would offer far more value, this statement of outperformance still seems to be holding true. Why should investors then pay more for actively managed funds? Because relative to many passive funds, the fees on actively managed funds don't seem to be justified, let's be honest. Considering the compounding returns of the lower fees over time that you could actually invest instead of paying to the fund manager, and if we also then could assume the same rate of return on both funds, you're really far better off in terms of overall return with a passively managed lower cost fund. But both styles are flawed and both have good elements. It all comes back to you, I think, and acknowledging different perspectives and different solutions may be required for different people in different circumstances. So professionally, and most of the times personally too, I would genuinely be pretty neutral, kind of like 50-50 on this one. That said, a reminder that our guest today works with S&P DJI. S&P Dow Jones Indices is a global leader in providing investable and benchmark indices to the financial markets. So they're kind of a key player in the passive investment space. Now, fellow travelers in both space and time, everyday investors, let us engage in the pursuit of freedom that comes from growing genuine wealth. Let's begin with today's show. Hope you enjoy. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. So thanks for coming in and sharing with me.
Thanks for having me.
I want to know a little bit about S&P DJI and a whole bunch of terms in between. So S&P, what, Standard & Poor's?
Originally Standard & Poor's and merged with the Dow Jones Indexing Company in 2012. So the combined entity actually goes all the way back to the late 19th century when a gentleman called Charles Dow started calculating the average price of a number of stocks and publishing them in what initially was called the Customer's Afternoon Letter, and he called it the Dow Index. That Customer's Letter eventually became the Wall Street Journal, and the Dow Jones Industrial Average still publishes today. I think it's 126 years.
That's pretty cool. But that was like the history of
that's where indexing began.
Yeah.
Today we have offices in I think over 20 countries around the world. We publish thousands of indices, including partnerships such as the S&P NZX. We have the 50, 20 indices like the S&P 500. I could keep going. There are a lot because now we cover indices for bonds, equities, commodities, more esoteric indices like the VIX, which your listeners might have heard of, but might not have. The investment industry has evolved to incorporate indices as not just benchmarks, but also vehicles for investment strategies and index funds.
So before we go there and talk to me about the investment stuff that piggybacks off these metrics, an index is what?
That's a really good question. You can start off with the Dow. Actually, the Dow Jones Industrial Average is it's calculated in a manner that actually you didn't need a computer to do it. Charles Dow actually did it himself. What he did was he calculated the average price of a basket of stocks. Now, each stock would go up or down every day by a certain amount, but by quoting the average, what he could give you is a representation for how the overall market was doing. And that's what indices still do today. They represent the performance of baskets of securities. They give you a clean measure of how an investment might perform, but they don't include things that the investment would include, like, for example, trading costs or fees. So it's a sort of a pure measure for a market or for a particular strategy.
Okay, so it's like a gauge, isn't it? It's really just like an instrument panel.
Yep.
either investors would use market commentators or even fund managers, I guess, and that's what is the next level here, right? So to manufacture and produce and maintain indexes is one part of it, but then to invest in an index fund means what? Means that I'm investing with a fund manager who just simply follows the basket of goods that are represented in the index?
Yeah, so I mean, look, indices were around for a very long time before anyone thought of doing an index fund. Index funds are about 50 years old. And what had happened historically was portfolio managers, investors would compare their own performance to this sort of nebulous notion of did I beat the market? And in order to represent the market, they might use an index like the S&P 500 or the Dow itself. And 50 years ago, it's actually a chap called Jack Bogle, who now pretty famous for founding Vanguard, thought, well, why don't I just, rather than try and beat the market, why don't I just try and capture the market? And hence the notion of an index fund, where rather than trying to pick stocks to beat the market, you just try and hold all the stocks in the market and replicate the market's performance. One of the more fascinating things, when index funds first came along, they were, I think it's fair to say, roundly mocked, because who wants to be average? I mean, surely the whole purpose of investing is to be above average. But the interesting thing, the fascinating thing, in fact, is that actually what the data has shown over the years is that market investing, or just tracking the market, is actually not just average. It's actually better over the long term than the vast majority of stock picking, what they call active managed funds. And that's something they'd be happy to talk more about, but it's one of the most fascinating facts of overall markets, that it is very difficult to beat the benchmark, and just getting the benchmark itself turns out to be far better than average.
So it feels, though, that I'm settling, right? Why would I want average when I can get the edge? Mathematics is one of the areas I know. I think you have, a Ph.D. in pure mathematics?
I do, for my sins, yeah.
So you probably know how averages work, is my suspicion, right?
Yep.
And it's probably like chance. You're going to be below average or above average.
Yeah, I mean, I guess there's two things going on, right? So, first of all, it's important to point out it's not a completely zero-sum game. Investing is not a zero-sum. If you and I could, in theory, put our money into the stock markets, and we could both get rich if the markets go up. What can't happen is we can't all be above average. Being above average is a zero-sum game. Someone to be above average, someone else needs to be below average. And that, importantly, is before you take into account the frictions that are involved with trying to beat the market. So what happens is that you have some people who just get the market performance. That's fine. You can do so at typically very low cost. Others who are trying to beat the market, that'll involve trading costs. That'll involve the cost of hiring a potentially expensive portfolio manager with all his skills and training and analysis. You also have to pay for things like data and actually the cost of trying to beat the market. You sort of start in a hole, and then you need to make sure that your outperformance gets you out of that hole. So what really happens is all the stock pickers themselves, in aggregate, they don't quite match up to the market's returns because of all the costs and fees that they face. And that's why just tracking the market, because it can be done at very low cost, ends up being, in many cases, historically an above average strategy.
So the strategy, therefore, is to at least get the average in an efficient way, and then let compounding take care of the rest, right?
Absolutely.
Okay. And so there's a lot of research that S&P put out, and I have come across the SPIVA stuff, S&P index versus active. Is that what it stands for?
That's absolutely right, yeah.
Talk to me about what that means. What's the purpose of it? How do you use it in terms of, is it just for marketing, or is it actually for helping in design new indices?
Yeah, so I mean, I guess in a few short minutes, I explained the theory, why you would expect an index-based investing to do all right. And there is a lot of debate around so-called active and passive investing, and what we try to do with our SPIVA scorecards is not to settle that debate, but just to better inform it with data. They first began now 20 years ago in the US. And the idea was really simple. What we do is we would take mutual funds, so open-end funds available to all investors, and we would assign them to their proper benchmark. So if you're a growth fund, you get a growth benchmark. If you're a bond fund, you get a bond benchmark, and so on. And then on a regular basis, just report the statistics. How many beat their benchmark, how many didn't beat their benchmark, how many survived, and so on. So the SPIVA scorecards, as I say, they've been run for 20 years now in the US, but we've expanded them to cover other fund markets around the world. They now cover 9 regions, not including New Zealand yet. We can talk about the reasons for that if you like, but we do cover most of the larger major fund markets. And what those scorecards show is, well, a couple of things. First of all, in most markets, in most years, most actively managed funds underperform. A typical number would be 2/3 underperforming. However, when you look over longer time horizons, that's where you start to see a much higher rate of underperformance. So over 10 years, 20 years, we recently ran a special edition of our scorecard because the ETF industry itself turned 30 years old when the first ever ETF was one tracking the S&P 500. It was listed in the US, and so we thought, okay, over this 30-year period, how many active funds beat the S&P 500? And the answer we found in the case of US equities was, well, not very many. 98% of actively managed funds either didn't survive or survived and failed to beat the S&P 500 period.
Okay, so effectively, the more you play Russian roulette, the more likely it is you're going to get shot.
Well, I think that, the longer you play, the higher the risk of underperformance. Yeah, I think that's fair.
It's probably a little bit more appropriate to say it like that, right? So you mentioned a phrase there, and I'm just going to pick on a few things just to help our audience kind of get an on-ramp as to where we're at here. And we're talking about passive investment versus active investment.
Yeah.
So passive investing is...
So passive investing is a way of investing where rather than trying to pick particular parts of the market or particular companies that you hope are going to do best, you instead take a very greedy approach. So I want all of them. But additionally, and there is an important additional feature here, you also invest in the proportion of the market's capacity to accept your investment. And now what I mean by that is larger companies get more of your money. And then what happens is then you end up with your own tiny little copy of the overall market. So if you imagine the overall market itself has more money, there's more money in the largest companies than the smallest. And what you do is you create a tiny copy, your own version of that, which puts, if the biggest company has 5% of the market, you're going to put 5% of your portfolio in the biggest company. That's the notion. Now, what typically happens in practice as well is you'll also use an index in order to measure or build that portfolio. Something like the S&P NZ 20 or 50, you might cut off, right? So strictly you should have all of them. Okay, maybe you can get most of the market if you just have some of the larger ones. They're more liquid. And so in the majority of cases when people are talking about investing, passive investing, what they mean is either directly or through a fund, you're tracking a market index.
Okay, so you're tracking the market index, and that phrase tracking, or that word tracking, is
if the market's up 5%, you should hope to be up 5%. And it makes life a lot easier. If you want to know how you've done over the long term, you could just check in the newspaper. What did the index do? Well, that's the same thing that should happen to you.
Okay, fantastic. Thank you. And Then on the active side, because we've kind of just talked about, we're basically what you're talking about is a recipe card or a rules-based system to determine which companies and what weighting.
Yes.
So in the active space, can you just take me through the paradigm there?
Well, in one sense, you can define active investing as everything that isn't passive. So unless you're just tracking the index, you're an active investor. And that obviously, what tends to happen is that's the more traditional notion of investment management. You might be doing fundamental research. You might be buying things that are going up. You might be buying things that you like their adverts. But it's the idea there is you are actively selecting the stocks that you want rather than taking a diversified approach.
So you're stopping, you're considering, you're learning, you're now analyzing it, and you're figuring out timing. Maybe you do a mixture of fundamental and technical analysis, and then you choose the right one. You have to pick the right stocks, right?
Yep.
And it's based on your reasoning and your own intellect.
Yep.
Highly subjective. You might win, you might not. And that's basically what we were saying before, is that the longer you play that game, statistically, the more likely that you just go below the market average of what you would have got if you just would have held a certain amount and just stick.
Yeah, and there's sort of various reasons why that ends up being the case. I mean, so you could compare it with, an extreme version of active investing is I'm just going to put all my money in my one favorite company. And just sort of think about the chances that you have for doing well. Now, actually, this can be quite counterintuitive, because what happens over time is actually you'll find that the vast majority of individual companies, the vast majority, will underperform a market benchmark. Why might that be so? Now, the answer is because what happens, there's an exponential scale of growth when it comes to companies. Right? A company might start and it could be worth $1 million, it could be worth $2 million. But there's almost no upside to that. Right now in the world, there are trillion-dollar companies. And so what tends to happen is you'll get some companies will do okay and very few will do fantastically well. Now, the sort of the mathematical way of describing this is skewed. It's positively skewed. You have a long right tail in the distribution. This happens in the case of New Zealand equities. This happens in the case of US equities, Japan equities. It's a feature of stock markets, because if you think about the value of a company, it can go down up to 100%. It can go up. Yeah, there's really no limit. Now, what happens then over time is these market indices, because they own everything, they're guaranteed to participate in whichever winners it turns out to be that are the winners. And actually, by the time they become, if they do, the largest companies in the world, then the market benchmark will actually have quite a lot invested in them. Now, because of this, historically, you'll find that over the long term, something like 2/3 to 80% of all individual companies will actually underperform market averages, which is it's when you start off, it's a counterintuitive fact, but when you think about it, yes, but there's going to be one or two that do really, really well and pull up the average. It does actually make sense.
It's so different to an individual investor who is actively managing their portfolio, where it's probably their entire wealth is held up by one or two really well-made decisions, and the rest of them might be well underperforming the average of their own personal portfolio. So you're kind of talking about the same thing, aren't you?
Yeah, I mean, it's. I guess it's a sort of consequences of the mathematics of it, really. Yeah.
Going to what we've seen recently, the biggest thing I was trying to think when you came in here this morning, I was just trying to think, well, what would be the counter argument to being a passive investor? What would an active manager, specifically say a fund manager who uses an active paradigm for their investment decisions, what would they say is the shortfall of passive management? And then the only thing I could think of, because I could kind of see the counterpoints on a few different levels, but the main thing that I was struggling with is the last 30 to 40 years, declining interest rates, floating all boats, Of course, passive is going to win, I would think, but is that too simplistic of an argument? And therefore, by extension, if we're now reversing that massive trend, should we see active winning over passive?
One certainly hears these kinds of arguments, and the market conditions that we saw last year in 2022 actually give a good example of that, in the sense that we saw interest rates going up around the world, we saw equity markets going down, we saw bond markets going down as well, so that the diversification became harder for everyone, and the potential value of a smart manager who could move you into cash was extremely high in terms of capital preservation and in terms of generating outperformance, right? Because if the market's down 20% and you're flat, then that's, even if you're down a little bit, that's still incredibly valuable. And above and beyond that, last year there was real opportunity, in the sense that if you looked at, say, the differing fortunes between energy companies and technology companies, someone who was able to astutely navigate those trends and identify those opportunities would have been able to generate a lot of value for their investors. The challenge comes back to sort of that first observation that I made, that we can't all be above average. An opportunity for glory is opportunity for embarrassment just as much. Now, because we've been analysing this data for more than 2 decades, I can actually share some sort of highlight observations on it. So is it true? Does stock pickers really prove their worth in down markets? And the answer is, unfortunately, it's still hard to be above average. And it's not true that these years like 2008 or during the downturn of March 2020 or during the tech bubble, it's not true that you see a material increase in active outperformance. And even more importantly, even if they do a little bit, and it's a mix, these numbers are quite noisy in the short term. But what doesn't happen is you don't see these big reversals changing the long-term statistics. It still will be the case that over 5, 10, 20-year periods, there's very little evidence to suppose it's anything but difficult to identify outperformers in advance.
Sure, and I guess, like, in my mind, I would have just thought, well, if I'm paying a higher fee, we haven't even talked about fees yet, but if I'm paying higher fees to use an active fund manager, then at worst, it's like insurance, where if the market does have a wobbly time, like you say, last year was a good example of that, then at least somebody's at the steering wheel and they can navigate through these choppy waters. But what you're basically saying is that if that was true, we would have seen that materialize last year.
And how often were they putting on their insurance when they didn't need to? And I think that's the thing. Like, if you are going to go to cash when you're concerned of a bit of trouble ahead, you'll be going into cash all the time. So in order to do this, what they just looked at a couple of indices. So the S&P 500 plus its mid-sized and small-sized companies equivalent. It's S&P 400 and the S&P 600. Your readers don't need to know which these indices are, but they're some of our popular US equity indices. And they looked at all the money that was in index funds tracking those indices over the last 25 odd years. Data series starts in 1995. And then they calculated how much fees were saved year on year compared to if that money had been invested in the average US actively managed fund with the average expense ratio. And you add those numbers up year on year. And we worked out that over the period, index funds tracking those indices had saved investors a cumulative $403 billion. Now, that gives you a sense of how much is taken in fees by active managers, and it's hard to generate that much value in an aggregate. It's also a question of compounding. Over 1 year, a fee of 1% takes away 1% of my portfolio. But over 30 years of taking off that 1% every year is going to take off, and well, in fact, because of the compounding effects, more than 30%.
Yeah. Portfolio. I can't remember where I heard this, but there was a book written about something along this where are all the customers' super yachts or something like that. I can't remember.
Where indeed,
you know about that?
It's by Fred Shred. It was published, I think, in the 1950s, and it's called "Where Are the Customers' Yachts?" And it's a wonderful book. I highly recommend it to your read.
Right. So the implication is that with all these fees being collected, when you look at all the yachts in Monaco, let's say, they're probably all owned by these fund managers. Of course, we don't know who owns them, right? But I'm sure there's no passive fund managers that own yachts, is the implication as well, right? But what that means, though, is that more people with more money in their back pocket is much better than a chosen few at the top. Effectively, what you're saying, rent seekers.
I really would double down on that recommendation. It's a wonderful book. It was written, I believe, in the 1950s, or published in the 1950s, and it was written by someone who'd worked as a broker during the Great Depression and saw the excesses of the 1920s. Now, of course, at that point in time, there were no index funds. The phrase "where are the customers' yachts" related to his observation that he saw lots of money being made in finance, but it was being made by the intermediaries and not by the people who were speculating.
Sure.
And I think that also connects to the notion of fees and frictions and trading costs being actually really quite important, but also to the difficulty in just getting rich by beating the market, especially if you keep, as it were, coming back to the table.
Fees traditionally may have been for buying outperformance or the promise of outperformance, and what you're saying is that promise is often unfulfilled. But fees these days, whatever fees there would be, ideally, like, and this is my view, right? I would like to think that those fees would go towards advice, because it's advice that will actually probably lead to better outcomes. Not advice on what stocks to pick, but advice around the bigger picture and what you're trying to achieve. Is that kind of the evolution that's almost being forced upon the industry?
It's a question of value added. And don't get me wrong, if you are one of these skilled stock pickers who can generate long-term outperformance, then you are worth those fees, right? That's not saying that nobody can do it. And in fact, even our Spiva data always, it's rarely 100%. It might be 95% underperformance, but there's still that 5%. But I think more importantly, we can talk about the value of advice. Now, I think there it can change to a different level of potential value, and I'll tell you why. We observe, just in sort of overall market trends and conversations with investors, I will observe that I think we often act against our best interests as investors. We want to buy things when everyone's excited. We want to sell things when it feels like the world's coming to an end. And of course, in hindsight, the worst time to sell is when everyone else is selling and panicking, and the worst time to buy is when everyone else is excited and buying. And I think an advisor, number one, can help investors build a plan and stick to it, which is very different from picking stocks. It's about the discipline of, as I say, sticking to a plan. I think other things that advisors can do is it's actually not that difficult sometimes to generate quite a lot of value in helping investors to control their costs. So cost management, behavioral discipline, and I mean, I'm not really here to talk about advisors as such, but it's a very different kind of value and kind of service that's being provided compared to say trying to pick stocks.
Back onto the index and just talk about how things evolve over time, because I look at technology, especially at the moment. I've been really just blown away by what's happening in the artificial intelligence space, and I'm also an investor in Kinsho New Economies Fund, I think it's called.
Yep.
And not a massive amount, but just to dip my toes in the water type thing. And so I kind of understand the value of using technology to construct and maintain the indices, but I don't really understand enough about how that works in practice. Like, if if an index is powered by technology and that technology changes, how does that therefore change the future expected returns on that index?
So we've been talking about market indices, and when we talked about them, we typically meant like things covering a whole market, like the S&P 500. But there are more specialized indices. You can have all the stocks in the energy sector, or all the stocks in the communication services sector, or whatever it is. More recently, there's been a new kind of index, or a new range of indices that the S&P Kensho New Economy is an example of this, and it's also one that had been selected the basis of an index fund in New Zealand, where the universe that you're trying to capture is a little bit different. And these are innovative technologies, so they include things like robotics, like space, and so on and so on. There's 38 in total innovative industries. Now, the same conceptual arguments apply in the sense of, I mean, you take something like a traditional biotechnology. I say traditional. There is a space of innovation, but biotechnology is a space in which there's often many, many little companies, one or two of whom may generate extreme returns. And it's that same skew situation where actually sometimes the optimal strategy isn't to try and identify which one of these 40 robotics companies or 200 biotechnology companies is going to be the success, but instead just go for participation on all of them, control costs. However, when you look at those spaces and things like wearable technology, it's often the case that it's difficult to identify those companies that might benefit. Okay, fine. We all know that there's an Apple Watch and that this is a wearable technology, but who else is involved in it? Who else might have something else coming out? And how do you identify companies that have participation in more sort of nebulous concepts like next generation offices, for example? And that's where AI comes in, and that's the Kensho in the index name. That's where that comes in. Kensho historically they were an independent company. They were acquired by S&P Dow Jones Indices, by S&P, I should say, and the technology was then integrated into some of our processes. So the use of AI there is in some senses a simple one, and it's just simply to identify, get a computer to read through all the filings made by every company and identify, one, is this company involved in wearables technology, and two, to what extent might they be involved in wearables technology? And because you would want ideally to do this across the whatever it is, it's 13,000 listed companies in the world, you're going to need an AI to help you there. And so that's how, in the case of the New Economies Composite, that's how artificial intelligence is being used. Yes, in a rules-based and in a relatively transparent way, but it's being used to help drive the index construction and maintenance.
I guess like a lot of people probably have a deeper appreciation of how AI works, especially with ChatGPT coming on the scene quite loudly towards the end of the year in most people's consciousness. So you can kind of understand how you could set something loose out there to gather a bunch of data and make it as complex as you want. And then you could therefore use that to build an index, which probably a bit more accurate. But we're talking about like a thematic index, right? Where
yes, but really it's the AI is being used there to identify companies that are involved in it in a certain segment.
So the efficient market hypothesis, right?
Yeah.
Will AI really just enhance that even more? In other words, like people can't really act on information that the market hasn't already adopted.
Yeah, I mean, there's I don't want to go too far into the theory of it, but can I guess as a personal belief, I don't think the markets are efficient. You don't have to believe in the efficient market hypothesis.
I thought that was like a prerequisite.
No, not at all.
It'll have to be a bit.
No, not at all. Look, it could be the case that Apple is overvalued. It could be the case that it's undervalued. But there are different. There's a huge difference between saying, I'm not sure the prices are right, and then saying, I know which direction they're wrong. it's clear. I mean, there's some. I credit Bob Schiller with the observation, the Nobel Prize-winning economist, and he pointed out a long time ago, if you look at how much the equity markets move up or down day to day, week to week, it's ridiculous. We do not every day get enough information about the future profits of all the companies for prices to be changing by that amount. The real challenge is that prices don't have to be right. It just needs, in order for it to make sense to take an index-based approach, it just needs to be hard to be smarter than average. So you don't have to believe markets are efficient to see the value in a low-cost index-based approach. But it's a weaker condition that the markets are not necessarily efficient, but I'm not smarter than the average market participant.
I see. So it's kind of removing the subjectivity out of it and just looking at what is and acknowledging your place in what is and then picking a side.
Yeah.
Okay. Like obviously we're living in changing times. It's a pretty scary time out there depending on which quarter of the world you look in. But it's also a really exciting and I think optimistic time too. And there's lots of opportunities perhaps to come out of where we're at. What I'm thinking of is during this time where there's added pressure on fund managers, maybe even investors and financial institutions to be more transparent and disclose more about the impact to the climate around our investment decisions. How can index investing or how can a manufacturer of indices make that easier for the industry to sort of transition and evolve into this new regime?
Yeah, thank you. I think that's a really important question because there is a worldwide fundamentals change that's been going on in the investment markets. It's not everywhere around the world, and it's not all investors, but increasingly investors, regulators, end investors, people who put their money in pension funds, are asking questions and challenging themselves around in climate in particular. Is their investment portfolio reflective of their beliefs? Is it containing or carrying risks related to energy transition that are perhaps not priced effectively by the overall market? And it has been, in some cases, been taken as a clarion call for active managers as like, well, this is why you shouldn't use an index because we're gonna think about this. It's my view that a transparent, rules-based approach to the space is one that will continue to prove its value. We, within the indexing business, have been working to build climate-aware or climate-focused indices for some time. But it's been a major change. We've gone from almost no money in these kinds of strategies 5-6 years ago to the end of last year. We had a total of 50 billion in assets tracking S&P indices specifically designed to address climate-related objectives. So these are around measuring the carbon emissions of the companies, reducing them, but also looking at their pathway. What's their plan? What is that company's transition plan for going forward? So we launched indices that took these factors into account, including the TCFD. And I should just do very quickly, the whole space is full of acronyms, right? You just have to accept that. There's a lot of acronyms. But I do think a data-led, transparent, evidence-based approach is not only possible, is also advantaged, I should say. And within the index and indexing fund space, it's one of the most rapid growing and interesting evolutions that we've seen in a couple of years.
And I can kind of see how this maybe fits together in a few areas. And one of them would be like transparency, and it's mechanical. Here's the formula. Here's what's happening. Somebody could take that and go, well, here's my disclosure. This is what we do. And they understand it, right? Whereas if it's kind of this nebulous, we try not to litter, Yeah, I don't know. Then that's probably not going to wash too much in the new world. We need to be quite specific, measured, and calculating, and therefore,
Yeah, and I think it's also important in terms of aligning your goals and your objectives with what the results are going to be. And I'll explain what I mean by that. Last year, 2022, was one of the best years ever for the traditional old dirty fossil fuel industry. So if you had at the beginning of last year looked to structure your investments in a way that you avoid heavy polluting or fossil fuel companies, then last year you would have missed out on some of those gains. And I think it's important, therefore, and that it gives you an example of why it's important to make sure that you're clear about what your objectives are, you're clear about what the risks are, and you're clear about what you're willing to miss out on potentially in order to have an aligned climate portfolio.
In other words, you might get lower rates of return if you decide to optimize for that.
You might do, but that's, as I say, well, this is why it's so important that it should be transparent, data-led, and clear what the methodology is. Because I think for many investors, they would have been prepared to sacrifice those returns, but you want to make sure that for example, that you're able to explain. If you're an advisor, you're able to explain to your stakeholders what's happened, why it's happening, and also help them prepare for what may happen next.
So it's about expectations, really, right?
Yep.
Okay, and that's cool, because we're like, there's so many areas I guess that we can go to around the ESG piece, but ultimately, being an index manufacturer, you can design whatever you want, right, to target any part of the market with precision, right? Like, that's the advantage. We're not using human intellect and judgment of smart people in a room and a bit of chance. We're using science, data, and we can pinpoint any part of the market, right? Like you say, you got indices for everything.
Yeah, I mean, up to a point, but yeah, I think the sentiment in what you say is absolutely right.
So just to finish up on, in terms of your general view on investor sentiment and attitudes towards passive investing in general, do you feel like that is just going to continue to get better and better and better? Like, can we conclusively say, and no bias here, of course, that active investing is dead? Long live passive forever? Or is it just getting started?
So first of all, active investing is certainly alive and kicking. And although it is
suffocating in a bag at the bottom of the river. Is that what you said?
Although it is much more prevalent today than it was 50 years ago, 30 years ago, 10 years ago. I think the notion of low-cost index-based investing is one that has resonated, particularly in the advisor community. But take a step back. You're still making active decisions about your active allocation between defensive assets like fixed income securities or cash in the equity markets. You're still making active decisions about how much you want to allocate to your investment portfolio versus your property, or et cetera, et cetera. So we're all still active investors. The question is, where do you want to spend your energy? Is it in picking one stock over another, or is it in thinking about the overall income risk return balance of a portfolio?
It's so good. Yeah, so it's like an active overlay using passive instruments. You're choosing asset classes, but you're not necessarily choosing specific stocks.
Yeah, absolutely.
That's awesome. Well, now where can people go if they want to learn a little bit more about S&P DGI? Where can they go?
Thank you very much for that question. We actually make the vast majority of all our research and education freely available to investors. We include our speed results around the world. You can read those. You can also examine the details of our indices. And I mentioned earlier, we publish our methodologies. If you want to know how any one of our indices work, you can go to our website and you can actually, if you want to, you can actually read the methodology. It's all there in black and white. So interested listeners could visit us at spdji.com.
Thanks so much, Tim, for joining me on this conversation. I appreciate that.
My pleasure.
All right, thank you very much. Tim Edwards from S&P DGI. I hope you enjoyed that perspective from Tim around passive investing. Now, I'd like to take a quick step back and gain a broader perspective, leave you with one quick thought before we finish up with this one today. Now, if you, like me, are looking out there at society at the moment and you're feeling a little bit dismayed at the distraction of disharmony and the diversion of division at play right now, please consider this. A divided kingdom eventually fails. When disunity prevails instead of community, our collective wealth becomes the plunder for the enemy. Whether it's an investment paradigm like active or passive investing today, or a political view, diversification is what you do when you're in doubt. Doubling down, therefore, is kind of ill-advised. So in your real life, outside of listening to podcasts around things that interest you, and I hope you don't mind me encouraging you here, keep embracing diverse perspectives, especially the ones you don't like at the moment. Don't just tolerate it, but really try to get it. We risk losing our shared prosperity as a nation and our individual wealth the more we congregate around polarized and politicized positions. Now, somewhat connected to that is the fact that shortly I'll start removing some of my older episodes and those with somewhat controversial views that may offend some in today's audience. I'll let you know how to access them separately, of course, in due course, but I thought I'd give you plenty of opportunity, plenty of warning, just in case you wanted to binge out on every episode you can still find in there. Get into it right now. All right, that's it for me for this week, though. Next week, it'll be something entirely different. I can promise you that. Have a great week. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Gero & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.